I'm getting ready to run for president and be like, you know what I'm gonna do? Nothing. Like, I'm not raising taxes. I'm not lowering taxes. I'm just gonna let you guys like chill. This country is so turbulent.
Skippy, the do-nothing president.
Yeah.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Mr. Skippy.
What's up, Doogles?
We are embarking on the real first day of spring, I feel like, today.
Today?
Today.
Is this supposed to snow next week?
Probably. Let's dive into the fishbowl a little bit. I think you mentioned the potential for some pizza.
Oh, did I ever?
Now I don't quite understand how the pizza is going to work on the podcast, but
okay. So
you always pull something off.
Let's talk about your favorite college town, Doogles. Actually, don't even talk about your favorite college town. If I told you there was an exhaustive study done on the best pizza joint in every college town, and these are Power 5 conference college towns.
I call you a liar.
Oh, yeah, you'd be right. But if I told you that one of these names, a pretty prominent university, the best pizza joint is Chuck E. Cheese, first of all, would you believe me? And second of all, what would your guess be?
I'm trying to guess what the town is.
The town, yeah.
Okay, so there's 0% chance that Chuck E. Cheese, like Showtime Biz, is the number one pizza. That stuff is like, it's like as if you made a piece of cardboard, threw some like Velveeta on it, and put it next to a vent for 12 hours. There's 0% chance.
I mean, but I'm told this is basically the only pizza joint in the town. My research tells me.
So okay, I gotta go. I wanted to go like Columbia for a moment. No, I can't even disgrace with a guess.
This is so great because we're going to talk about Columbia, Missouri next. No, it's Tuscaloosa, Alabama, baby.
Oh,
the best pizza
no
joint.
way!
You get number one football players in America to come eat some Chuck E. Cheese. Like, this tells you they're handing people bags of money. I mean, come on. All right, so yeah, let me hit you with a couple more. Actually, I already mentioned it. Shakespeare's Pizza in Columbia, Missouri.
Boom.
On the list. Shakespeare's quality spot. I definitely recommend that. A couple more shout outs here. Pies and Pints in Kentucky is a good spot. Where else?
Where are you going with this?
Yeah, I don't know. I just love pizza, and I love Is that your nice way of telling me to move on? All right, we're moving on.
No, I just didn't know because there's this company Slice that just raised a whole bunch of VC funding. I wasn't sure if you were going down that road.
I know Slice, man. One of the local pizza joints around here uses Sliced. And we should talk about their business model sometime. So yeah,
put it on the back burner.
There we go. I'll put that on the Twitter if you guys want to check out the best pizza joint in every college town in America.
All right, can we bring some sense back to this podcast?
Yeah, let's do it. We got some listener mail, and we actually got a decent amount of listener mail. We're gonna
I think we got to split it up a little bit
in depth.
Yeah, I think we got to split it up. Yeah, I'll save some for next week, but let's go into Chris sent us a little mail. Gonna start there.
Yeah, first of all, what's up, Chris? Thanks for the mail. Long list of questions here, all really good stuff. So we've covered some of this in past episodes, but I know it's hard to get back through everything. So I think a refresher is really nice. Chris's first question talks about picking individual stocks rather than indexing. And basically, I love this question. Like, do you guys believe you are above average investors? Because a lot of times on the show, we're pontificating about individual stocks. I guess on my side, yes, I do believe I'm an above average investor. I think my track record shows that, but that's one of the contradictory things about investing, which is really crazy, is like 90 plus, maybe as high as 99% of people should probably not pick individual stocks. But then the people that end up talking about investing and sometimes, in quotes, giving advice about investing are often that, that 5% or whatever that maybe is equipped to pick individual stocks. So I do pick individual stocks. I have a methodology and like a 20-year history around it. And there's a reason I'm comfortable with it. But absolutely, Chris, I agree that probably the average investor, or as like Buffett calls it, the know-nothing investor, should probably not pick individual stocks.
Agreed on the vast majority of investors not picking individual stocks. And as you point out in a couple of the docs that you sent over, Chris, like generally speaking, I mean, the data, we talked about the Dalbar methodology before, and whether you go along with that methodology or not, or look at something else, like the results are not positive for the general average individual investor picking stocks. So that's why I've talked about how when folks generally come to me, I'll be like, I think you should just invest in the market, which I view as VTI, which is Vanguard's total market index. But yeah, Skippy and I have different methodologies that we both use and different strategies, but believe in those strategies and do believe that they're above average. Is it worth giving a 2-minute on each of them?
Yeah, absolutely. I mean, my strategy comes out basically pops out of chapter 14 of the Intelligent Investor by Benjamin Graham. And as we've detailed on the show plenty, there's lots of history around value investing outperforming over the long term. I'm going to talk on another book that I'm in the middle of right now that makes that crystal clear. But on top of that, it'd be one thing for someone else to read that book and decide they want to do this. But if that's not their natural temperament and they can't stick with that strategy when it underperforms for a 5-year stretch, they're going to end up on the wrong side of things. In my case, that kind of fits my temperament, and I fully believe in the core principles, and so I can ride with it through thick and thin. Doogles, we've talked about this, but when you talk about picking individual stocks and you talk about finding a strategy that works for you, the psychological component here is probably the most difficult thing.
Critical. Yeah, absolutely critical. Because just like you said, you can ride through the thick and thin. And like with my strategy, there's some thick that happens, or the thin. I'm not sure which one is the negative side, but pretty material drawdowns. And it's different than the value side that Skippy talked about. I go momentum. Or I call it long trend momentum. Typical momentum strategies look at pretty short time horizons, like 1 day, 1 month, 3 month, kind of 12-month type returns. And then they'll invest for a similar like short-term time horizon on the other side. And mentally going back to the psychology, like I just can't get comfortable with that short of a performance period dictating what I do. And so I don't go with that style of momentum. I look at companies' performance and look at those companies that are at least 5 years public and have outperformed the market and peers pretty substantially and consistently over long periods of time, up to 20 years. And so considerable outperformance is like about 3x the market is what we're talking about. And then also are showing really strong additional momentum over the last 1 year, 5 year, 3 year, 5 year, and 10-year time horizon. So it's pretty long trend of what I look at. It's confidence, and as Skippy was saying, just confidence in the model itself. I look at the data, and while there are significant drawdowns over any 10-year period over the last 50 years, on average, it beat the market by about 50%. Over any 20-year period, on the average, it beat the market by about 3x. And over that time period and back testing, beat the market by about 17x. And I just kind of have faith in that. And so far, it's performed really well for me. So that's where I'd say yes, above average, both from a return perspective and in my eyes, also what we talked about from a psychology perspective. I think in understanding that psychology and addressing it and acknowledging it, that alone, I think, can make someone at least have the temperament to be an above average investor.
Yeah, and there's so many trade-offs here, right? I think temperament is key. There's so much great, whether it's podcasting material, reading material, whatever else, that's free today. I would say anyone that's interested could probably skill up to be an above average investor. The question is if that really makes sense for you. Like if that trade-off of spending nights and weekends potentially researching stocks is where you want to go. And for most people, not only is that not necessarily fun, but then on top of that, the swings in performance, the turbulence that comes with investing in equities, even if it starts off as fun because you make a few bucks, becomes a lot less fun when you start losing. Chris, even the average investor that maybe should invest in the market, they still, I think, have to think about how they manage their temperament and the psychological component that comes with the swings of the market. And like for someone like my dad, that was, I'm just going to put money in my 401k and never look at the thing. You know, that was his management strategy, and he ended up in good shape because of it. But I think that's what I'd urge is kind of some self-reflection, not necessarily for you, Chris. I imagine you're an above average investor, but for your average person about what does this mean? What am I getting myself into? How do I manage the psychological component of this piece of the game? Because I don't think the human brain is typically wired for it.
How about podcasts you listen to, man? That was another question that Chris asked. What are your faves?
I think I really like Invest Like the Best by Patrick O'Shaughnessy. He's smart. He's great at asking questions, and he now has the cachet to get almost any guest he wants. I mean, I won't be surprised if a president shows up on that in the near future. We've talked about Masters in Business. There's some really good stuff on there.
Yeah,
I like Meb Favor Show for sure on occasion. How about you?
Yeah, so those I like, and then a couple on the I'll just call it the business side and the startup side that I like. Pivot, I like a lot. This Week in Startups, I like a lot. Capital Allocators is a good one, I think, on the investor side. And then the 20-minute VC is one on like the venture capital space and startup space, which I think is pretty cool. So those are some. I listen to a whole bunch of podcasts that have nothing to do with business or investing that I'll leave out of this one, but those are the tops that I typically go to when it comes to the business investing side.
A lot of great investors have said, and I think it's been proven, that many of your best investment ideas come from other fields. So I definitely do some investing podcasting and some investing reading, but I cherish the stuff outside of the field because I think that's where you are able to connect the dots between multiple fields in a way that can sometimes meaningfully improve your investment strategy. And so I'd really encourage that.
Yeah, fully agree. And even outside the podcast world, I just finished a book called Thinking in Systems, which is similarly, it touches on how governments work, how corporations work, how like bathtubs work, right? It's just like kind of looking at systems generally and how you can inject or take inflows, outflows, and how that works with systems. And I think things like that just open horizons. And making those patterns, I think, goes a heck of a long way. So I love it.
Yeah. Chris also talked about common stock and potentially sharing our portfolio with others. I mean, there's a disclaimer at the beginning of the show. You know, we're not trying to brand this as investment advice. But Chris, we are thinking long term about doing deep dives into the portfolios, breaking down some historical performance and those sort of things. So stay tuned there, and we'll probably give you some more insights. I know my rebalance is coming up like early June, and I'll definitely do a deep dive on the past year and kind of what's showing up on the screens going forward for me. So
I'm excited about that.
On that.
I'm really
Thanks
excited
so
about
much for the email, Chris. We loved it. Hopefully we did justice to your questions. We also, I got a shout out to my boy Jack Doogles. So Jack, thanks for the email as well. What else do we have today, Doogles?
Not finalized yet. However, just when you got Biden fatigue, I'm going to talk about him again. Get back in the room.
When do you want do you want my rant to start or to end this?
Let's just maybe somewhere in the middle. So basically, next week, Biden's going in front of Congress to talk about a whole bunch of stuff. One of the things, though, that he's going to talk about, we got a little bit of a hint of on Thursday this week, which is increasing the long-term capital gains tax, right, for wealthier Americans. So what he's saying and what the proposal seems like it's going to be at a high level is to change the long-term capital gains tax to actually map to the ordinary income tax, which is what short-term capital gains does for individuals that make over $1 million a year, right? So it's going to increase the tax rate there for the ordinary income tax to 39.6, I think it is, and then also increase the long-term capital gains tax from 20%, where it is today, up to that 39.6 plus the Medicare expansion surcharge. So
yeah, which is like 3.8 plus you could pay state and local taxes on this stuff as well.
Exactly.
So
you're looking,
I mean, you could be 43.8 or something like that, 43 something, plus some other nonsense. It's I think they're saying in the state of New York, like in New York City, I think it's north of 55%, maybe pushing 60%.
I think it's hitting similar rates if you go over to California, some places in California too. Yeah, it's pretty high. It's substantial. And so there's so much detail that we still don't have, but just in the concept, I want to talk about the concept of it for a moment. Give me your initial reaction and we can dive in a little bit.
I don't understand the persecution of business owners. And I know that's not how most people think of it. And I think that's where I get frustrated. Like when you own stock in a company, you are a business owner and it's that simple. So, why you want to take more money away from your business owners, it's just frustrating to me. It's not like, no one goes, oh, my local pizza shop in my favorite college town, I should just go steal some more of their profits. But that's kind of, in a way, what you're doing. And you're talking about doubling the capital gains. Now, I know it is now, Doogles, is it for people making over $1 million or people with a net worth of more than $1 million?
People make annual income.
Okay, annual income. So the counter argument here is, come on, this is nobody. Like, this is a very small sliver of people. But it just leaves me with an icky taste in my mouth, I guess, is my initial reaction.
Yeah, I mean, I have a couple reactions. I think one is, I mean, he's got $4 trillion. You got to figure out how to pay for. So that's one side, right? So how do you pay for it? I think it's going back to thinking in systems, I think for a moment, this is not anything from the book, but just generally thinking in systems. I think we need to see the full picture first. It's hard to look at this coming in dribs and drabs because like we don't know what might happen with the corporate tax rate, right? And to your point, if you increase the corporate tax rate, and part of the rationale that I've seen around having a lower capital gains tax rate is to try and mitigate the impact of like a double tax, basically, because you're taxing the corporation, then you're taxing the business owners, right? Additionally. Yeah. And so if you increase the corporate tax rate, increase the long-term capital gains rate, what does that do to the full system? Right? I think we need to look at this systematically. So there's a question I have there. From a Pilchetti perspective, right? We've talked about capital in the 21st century. He argues that because in his universal law, R is greater than G, meaning the rate of return on capital is perpetually greater than the rate of return on growth, that leads to inequality. So taxing capital additionally to feed that back into the system is a way to reduce inequality. If you look at that from an economics perspective, from Pilchetti's economics perspective, not the whatever 80% of people that disagreed with Pilchetti, then you can say this is a way for us to try and tie back inequality.
I still found errors in his spreadsheet, man. But no, this is why I love talking to you, because I like to think through this from multiple perspectives. I guess I don't hear, we'll talk about this next week or the week after when it gets fully baked, right? But I don't hear him with that logic necessarily being like, this is how I'm solving inequality in America. This podcast's official stance on that is the reverse. We want to see more people start to own businesses, of all income levels, better understand that that's a way that a lot of people generate wealth. And so I'd like to see it flip. I don't necessarily want to tax the current equity owners more. I want more people to own equities and more people to understand how to grow their wealth from that perspective. But that's not an easy fix either. And that's something that the government can't really do anything about. And that certainly is not raising $4 trillion.
Let me throw or go back to one thing we talked about before to get your view on. And then can we quizzelate a little bit, and perpetrate? Yeah. All right. So before we talked about incentivizing even longer term holds. What could be interesting is if we made like a 3-year, 5-year threshold that had a lower tax rate. If you do this, if you increase if you basically make short-term capital gains, anything from 0 to 5, and then make 5 low. I think that I haven't thought that one through a lot, but there could be something interesting, I think, in that. That's again going back to like thinking about the system. If you want to incentivize longer term business holding, because you could argue that someone holding a stock for 3 months, 6 months, 9 months, 12 months, 15 months, are you really a business owner? Like, I mean, you could conceptually start to make that argument. I don't know if I agree with that question, but I'm throwing it out there.
If I'm a business and I'm raising capital by issuing equities and people are buying those and providing that liquidity, I don't really care. If they provide me the money I need to run my business and then they sell them to someone else 3 months later, I don't really care. They still gave me the money I needed when I need it as part of my capital, my equity structure. Yeah. So this just leaves a sour taste in my mouth. And this is, I mentioned this last time, but I'm getting ready to run for president and be like, you know what I'm going to do? Nothing. Like, I'm not raising taxes. I'm not lowering taxes. I'm just going to let you guys chill. This country is so turbulent.
Skippy, the do nothing president.
Yeah. Yeah. Right. You'd vote for me, wouldn't you? I mean, no, I'm not messing with anything.
I'm taking the fifth on that one.
I just feel like all sides are so polar opposites, and they tend to not represent the middle 80% of the country. And that's probably the middle 60% of the country. I don't know that people were hollering come raise our taxes. And in the previous administration, I don't know that people were hollering come lower our taxes.
Yeah, let's wait to see. Let's go deeper into this. Let's wait to see what he says. But yeah, I hear you. Let's get the detail. Come back to it. In the meantime, Quizilation, you ready for it?
Yeah, I'm ready.
There's nothing more exciting than a tax quiz. So let's go to just marginal income tax rates. This is not capital gains for a second.
Okay.
What was the highest marginal income tax rate in the history of the United States? And this is federal.
94%.
Not half bad. 91%. Oh no, sorry, 92%. 92%. So all of the highness, your highness, was in the 50s, and it was either 91 or 92% throughout the 1950s. What's the lowest
at the federal level?
Federal.
Well, I mean, if you make less than $10,000, you don't pay any tax, right? So is it zero?
Okay, sorry. What was let me. Okay. You got my question was incorrect. The lowest top marginal tax rate.
Yeah.
You were absolutely correct in your answer for that.
31?
7.
No,
so
when was that?
Yeah, back when it started, 1913, 1914, 1915 was 7%. Because for a time we didn't have income taxes, right?
Yeah.
And then it we had some highs, some lows. It was high for a bit though. I mean, we had a lot of, oh no, you know what? I actually missed 2 years. 94% was the highest. You were right. In 1944, 1945, get them war dollars going. It was at the end of World War II.
I thought I knew that one actually.
You're right.
All
right.
Okay. So wait, 1912, 1913, did it come in as a 7% for everyone, regardless of your income, or was it always tiered?
1913 to 15. I have to go look. I'm not sure. That's a good question.
I mean,
I might once Biden talks to Congress, I may go into a little bit more depth here, but go. Roll it out.
I've always thought that the tiered approach, the fact that the tiered approach is never questioned, pretty much across the world, is always a little bit of a bizarre thing to me. But I get it, and now
trying to avoid a regressive
conversation.
Yeah, you just want to avoid a regressive tax. That's the That's the issue. Yep. All right. Highest long-term capital gains rate. This is going back to 1954. The data I'm looking at.
Ooh, hold on. Going back to 1954, 35%.
39.875%, which existed from 1976 to 1978. So that was coming out of the stagflation, or going through, I should say, the stagflation OPEC situation. What was the lowest?
I have the 1920s is 12-ish%.
Well, this only goes back to 1954. So, I mean, you broke the rules. First, break all the rules. I see you read that.
Yeah. So 15%.
Yeah. What are you? Looks like you're looking at Google. Is this a real?
No, this is in my fishbowl actually. So I have a whole chart. I'm gonna throw this on the Twitter too. Cool. I didn't even realize that I could cheat until just a moment ago. But
You're not good at it, I tell you that much. At least keep your eyes on the prize over here.
So this is crazy. It actually, mine's from, I think this is from Bloomberg. They have slightly different figures. They're showing basically like the 40s through the almost late 60s at 25%. Then they show a peak up to 35% in the 70s. Looks like it came all the way back down to 20% and then jumped
80s.
back to like 27%. Bottomed out. Gosh, is this the Bush era?
Yeah.
No, is this Clinton at 15%?
Bush took it down to 15.
Okay, yeah. So that's
Bush
Bush,
took it, and then Obama bumped it up to where it is today.
Yeah. I mean, so a lot of this stuff, if you have, let's say, 50 plus years of history, those help set the bounds pretty nicely, I think. Yeah, we'd be going to the highest capital gains tax in the history of America. Now, only for people that make more than $1 million a year, but it just seems outsized to me.
Yeah, and there's a point. Going back to Piketty's Capital in the 21st Century, there was one argument that he made was around how when you get to a certain place, I don't know if 40%, 43% is that place, but when you get to like 91%, like when you start getting to that point, it's less about the tax itself because most people aren't going to be paying that, and it's more about record keeping and trying to find things that are off the books and get them onto the books, which I don't know if that incentivizes or disincentivizes, but I thought it was interesting. Just starting to track something you didn't track before. I don't think that that's the purpose of this. This is definitely money, because Biden's going after, as we talked about last time, foreign, tax of Americans. He's trying to bring in all the tax to pay for these things. But yeah, I thought it was interesting.
Well, so this is the thing we need to do a deep dive on next week, or assuming if this passes, right? This is going to change investment strategies. Like if I'm sitting in California and I have to pay 60-ish% of my capital gains, that could totally make it. Let's just use me as an example. That could make a strategy that I've back tested, and taken taxes out and taken transaction costs and everything, accounted for all those things. I'm going to have to redo all those back tests because it like might not make sense for me to do this anymore. It's just crazy, the potential implications. And here's the thing that I don't think Biden fully understands yet. And I'm not sure that many people fully understand it, but so it's like what you said. If my tax rate was 94%, I'm not paying that. I'm either leaving the country or I'm hiding my income or I'm doing something, right? There's no chance I'm giving someone 94% of my earnings. What's going to happen if capital gains tax is north of 40% is I'm going to hide my assets from the US government. And just within the past 10 years, there's actually ways to do that. And I'm talking about cryptos here, where you can
always comes back to cryptos, cryptic cryptos,
which is crazy because I'm the value guy and cryptos are absolute craziness. But now more than any time, if you're talking about the 1980s, like where do I hide my investments from the government? I think that's pretty damn hard to do.
Well,
right now, I could buy a bunch of Bitcoin with an anonymous wallet and just laugh at them as they try and get taxes from me.
Let me throw a different angle in there. Because one thing that's interesting is that there are a number of wealthy individuals, right, that hide their income in investments in order to avoid income, right? A big category I'll throw out is carried interest, right, for private equity firms. Yeah. So carried interest, like a simplest way to think about it is that you look at the amount that's invested of a firm, and a percent of that amount goes to income for partners that they call carried interest. And that carried interest is actually, it's taxed at capital gains rate, but it's effectively your salary. I mean, like in many ways to look at it, it's basically your salary, but you get this lower tax rate on it. And this is where I might be convoluting a couple things, but I don't think so. But I think this is where a lot of, what's his name? Mitt Romney, where his $1 trillion IRA comes from. Have you read about Mitt's, like, it's not $1 trillion, but it's like Mitt Romney has this insanely valued Roth IRA, has been able to put his carried interest from Bain Capital hedge fund into a Roth IRA. And it's basically now earning all kinds of cash free, or sorry, tax free on the back end,
Yeah.
because it's a Roth. But I think that's like an interesting. I wonder if there are other categories, right? That's one category. PE firms carried interest, but I wonder if there are other categories where people are hiding income in investments in order to avoid some tax too.
Yeah, well, and I think there's actually some discussion about carried interest with this capital gains plan. And I forget how they were speculating they'd do it, but there was some speculation that almost like each year they might make you you're gonna laugh at the term, like mark to market like that and pay some taxes on it. Like there was some
like unrealized
rumor about
gains?
that going on because the carried interest loophole, call it, is it's a big loophole. But hey, like Romney's not spending that money right now, so you're gonna tax him on stuff that, man, I don't know.
No, it's a fascinating discussion. Let's see the more detail that he throws out. But I think we got to look at the whole system, right? Even going back to what we talked about with Joel Greenblatt, right? Like I think this also becomes interesting because if you can further incentivize people to go to retirement accounts where this tax, I don't think, is going to apply, right? And you can increase limits, but have an additional tax on top of your limits today, like we talked about, right? IRA, $6,000 a year if you're under the age of 50. You make that $10,000-$12,000, but that extra $4K, $6K, you now tax somewhat. I think that if you create the right system around this,
well, if you create the right incentives, all incentives drive behavior. Creating the right incentives here is practically impossible. And I'm going to apologize to the listeners because I don't know that anyone wants to listen to politics and tax policy. But hey, we're keeping going.
No
here.
one has wanted to listen to anything we've talked about, but we still talk about it. Why are you bringing that up now?
So what's going to happen here? You talked about retirement accounts. Like, so let's say I make some money and I have a decent sized retirement account and I'm freaking retired. Now, my understanding of this is I sell some stuff and make $1 million in gains. That's going to get taxed at the 40%. And then that $1 million is going to be considered my income. And then I'm going to be taxed on the income of that sale. Like, and then I'm going to go to Target and then I'm going to pay the 10% tax on top of that. It just seems like I just have tax fatigue, man. I can't take it anymore.
Wait, so you got cost fatigue and revenue fatigue?
I got all sorts.
This is why you're the do nothing president.
Which is why you should vote for me, man.
I like this. All right, enough with the taxes. Fishbowl. What else you got?
All right, I want to talk briefly. There's a brilliant book came out Tuesday. It's by William Green. It's called Richer, Wiser, Happier. It's gonna end up. I'm pretty sure it's gonna end up in my top 5 recommendations of all time.
Oh, you gotta be kidding!
Incredible.
Are you
really,
done with
really
it?
Good? No, I'm halfully through. So I just want to throw a couple.
That's
facts
quite a recommendation.
This book is great. I check it out. So let me throw a few facts your way. Basically, it's breaking down the world's best investors and their strategies, and kind of have as a lifetime a reflection. And because it's brand new, it talks about coronavirus, it talks about what happened in 2020. It goes through people's, talks about Graham and Marx and everybody you can imagine. Everyone throws around the Templeton name. And like, I'm generally aware of him, but I hadn't read a decent breakdown. So one, apparently he's a very nutty guy. And I'll tell you, I'm confident that this is a true fact. Who's the best investor ever to denounce his U.S. citizenship? It's definitely John Templeton, man. The guy went to Yale. The guy made all sorts of money here. And then he's like, I think I'm moving to Bermuda. I'm out of this joint, or the Bahamas or somewhere. And became a UK citizen. Isn't that freaking crazy?
Okay. Tell me more about the craziness.
All right. So in 1939, he takes on leverage to buy 104 stocks, including some that are bankrupt, with a simple hypothesis of, the world's at war. everything looks really bad. This is the moment of greatest pessimism. I should buy some stocks. Like, that's incredible. Incredible foresight, incredible mean reversion. 5 years later, he makes 5x on this investment. It's a really fascinating thing. Here's what I want to hammer on, Doogles, and it's not necessarily with John Templeton, but with anybody. If the U.S. doesn't win World War II, that is not a fabulous investment. And no one writes a book about John Templeton being one of the greatest investors of his generation. So,
Yeah, probably
in
not.
your
Probably
eyes,
not.
does that mean he made a great investment or not?
Yeah, it does. I mean, so one thing I think is really important is I'm a poker player, and within that world, but I think in general, it's very important to separate outcomes from whether or not something
Yes.
was a good decision. So whether or not it was a good investment, I'd have to look at like his specific analysis, right, to see what like risk reward I think was. But everything in investments is a bet, right? I mean,
With a probabilistic outcome. Yeah.
Exactly, right. And so I think I feel like I remember. I think he might have been written about in a Common Stock and Uncommon Profit. I think the Philip Fisher book too. I
Yeah.
think for some reason, but yeah, I think it probably was. And depending on, you said he made it in 39.
Yeah.
So that actually, if he made these investments in 39, the U.S. has nothing to do with this. I mean, the U.S. didn't even come into the war for this. So this is, you're betting that the world's not going to come to an end, like at that point. So
that was
risky
effectively
air.
the calculus, and he was effectively saying it was almost one of those, give me the companies that have struggled most. I forget his exact criteria, but it was a straight value play, mean reversion. Like, these things fell off a cliff, and when they come back, they're going to come roaring back. And I expect, basically the world to survive, us to get to the other side. The point I want to make, because I just always think luck is overlooked, is like, man, he probably had a French counterpart that was just as brilliant, same temperament, made that same bet maybe with French stocks, and didn't get those returns in 1944. So I think that's always important to point out. This dude, he's
the only thing I'll throw out is just going back to what we were talking about before, is he came out of this at a point where there was a 94% tax rate. So I don't know how that impacted. I don't know what the long-term capital gains was, but I'm curious as to what the net return.
I was throwing shade about him denouncing his U.S. citizenship. I think I just figured it out, man.
that very well might be it.
The other thing that I just want to point out, so he made his first massive bet 1939, 60 years later. 60 years later. A lot of people don't even live 60 years. He's still in his investment like lifetime, 60 years later. He 1999, he shorted 84 tech stocks. He put over $2 million each in each of these shorts. And
does he give a
something
month?
Like 185 million total. Again, he had so much money at this point. I don't know that that's
Does he give a month though? Is there a month in there?
Not in my notes, but certainly in the book. I think it was like November maybe.
Oh, okay. Wow.
But made tons of money on that as well. Like, really interesting, fascinating dude. The other thing I'll mention with my John Templeton knowledge that I just never knew is this dude was, when he was wealthy, he was going to places like Harvard because he's a deeply religious man and saying, I will give you millions of dollars to study things like if prayer works in a scientific way. And that, again, that's a very unique thing to John Templeton. Not many deeply religious people are also like scientific and analytical enough to be like, connect these two worlds. And I think that's a really fascinating thing. Like, I would love reading those studies because that approach is not often taken, right? And so it just shows you, odd guy, smart guy. I don't know if I want to emulate his life or anything, but interesting character.
I know that you don't. So that is.
Hey, I might want to work out in the ocean every day.
That's true. Can you throw out that book title one more again?
The book title is Richer, Wiser, Happier by William Green.
Awesome. It's on the list now. It's on the list. Cool.
It's really
Appreciate
good, man.
that.
Okay, one last quiz for you, and then we may be wrapping it up. So we know that investors in the late 80s got fascinated with the Japanese stock market, right?
Yeah, remember we talked about that a little while ago.
It led CAPE, the cyclically adjusted price to earnings ratio, up to, was it 100-ish? I mean,
it's
like
something silly,
unheard of values.
And real estate specifically as well was out of control.
Real estate, yeah. Japan, relatively small country in terms of land and population in the grand scheme of the world, right? But the innovation that was happening there in the 80s was captivating and definitely led to a bubble.
Don't they have the second largest stock market in the world by market cap?
Today?
I think today they might. US, Japan, then China, I think. But anyway, keep going.
Let's run those numbers. But that's perfect. That leads directly into my conversation. So what percentage of investments by market cap did Japan have in 1989? So basically, all of Japanese equities compared to all of the world's equities were worth what at the peak of the bubble, Doogles? That's your question.
Percent wise?
Yeah, percent wise.
Let's say 68.
Wow. 68 would be crazy. 45%. So, I mean,
see, I'm like beyond though. You know what I'm saying? I'm beyond the bubble.
You're beyond the bubble. But like the US right now is I think it's 50, well, it was 52% a while back and it's grown. Yeah. Let's see. Anything else on your list?
I'm trying to, there's so much like records amounts of cash in places. And I want to pull out like those different units and then get a sense for what that, by a sense, I really mean like a perspective on what that means. Meaning like the different places I've seen this are record consumer savings in the US over the past year. Private equity firms have a record amount of unspent cash. SPACs have raised $100 billion they need to spend. And I'm kind of just like, there's like all this money that's sitting out there. And and then you have, I don't know how much cash in margin debt, but I'm just like what happens to it?
This exact thing happened to me this week. And like I had that exact same thought. And now I think that thought is wrong. There appears to be record amounts of cash, but that's because there's record amounts of debt. And you forget, or I forget. So
it's not just free cash.
Something like 85 or 90% of stocks are trading like above their 52-week moving average.
Like
or one of those metrics. Maybe it's a 20-week. Everything is at the top of the world because we're in a bubble, right? Like, and so I keep going, like, even you talk about all the crypto stuff. Like, so Dogecoin went to 39 cents or whatever. Do you know what that meant? The market cap was, I don't know the exact numbers, but like hundreds of millions of dollars. And I'm going, where did this hundreds of millions of dollars appear from out of thin air? And I'm going, there's something going on here. And then I go, everyone is borrowing. And that's why even Bitcoin went from 64,000 to like 47,000 in days. And there's speculation based on the blockchain analytics that was basically margin calls. So when this unravels, it's going to unravel so quickly.
Yeah, I think that conversation is even fascinating. Like I want to go in more deeply to even map that out, because it is really interesting. Like how much of this cash is spoken for effectively is like what we're looking at. But there's all this cash everywhere seemingly. Well, I mean, it exists. Just how much is spoken for, how much is not, right? I mean, you look at Archegos, right?
Yeah.
And it's just like microcosm. That's just one dude in his family office.
This is what I honestly don't know how to do. And if I knew the right person to ask, they'd be an amazing guest. But it's like, how do you put together a balance sheet for the world of like, and not the world, maybe it's the US, but it's like, it feels like there's, money in SPACs, money in PEs, money for people to do meme stocks and have them go to the moon. Like, feels like there's money everywhere. But what are the trade-offs and how does that unravel is the thing that I think is really hard to comprehend at a macro level. At a micro level, I think it gets a little easier. But it's still incredibly difficult.
Yeah, let's find somebody. This is just, I'm going to say fascinating because the other words are more frightening, but it is like it's a time, man. This is a time.
Well, that book, I mean, I don't know if it's all value investors. I certainly didn't buy it thinking it was all value investors, but so far it's been all value investors, and it talks a lot about in tough times in 1998, 1999, when their funds lagged behind the market, how, they either got fired or then they came roaring back because they were one of the only people in their field trying to still like live by fundamental analysis and rationale to say this is blowing up soon. And so it makes me really want to have, I'm not going to sell anything to go to cash, but I am going to continue to fortify my cash holdings because this is going to blow up and it's going to blow up quickly, but it could still be 3 years out. I don't know when it's going to blow up.
Yeah, we'll see. We'll keep watching the Doogles indicator.